Okay, so today we're going to be talking about crude oil, and this one is a bit experimental. I'm not going to be here next year, so I'm recording this lecture I usually give to our Envirothon team on YouTube, and I'm kind of acting like a teacher a little bit, so I've got an apple just so the image sinks in. So first off, we start, what is crude oil? At its root, it's made up of two atoms, carbon, hydrogen. It's a hydrocarbon. When you burn it, you get CO2. It's a fossil fuel, aka it is not renewable. All right, so it's a liquid, it's a hydrocarbon, and we use it to power almost every aspect of our modern world. I don't care if you're Buddhist, Christian, any denomination of Christian, Catholic, Lutheran, Hindu, whatever. If you live in the global economy today, your God outside of Sunday mornings may as well be crude oil. Now, when and where did most crude oil form? Basically, it formed in oceans. And the majority of the crude oil that we see today is not from the remains of big animals like sharks, octopi, squid, dinosaurs. It's really algae, particularly, plankton as well as algae, particularly phytoplankton, zooplankton, ancient copepods, those type of things. It gets buried underneath rock. That puts pressure upon that material, which is made up of carbon and hydrogen. It's organic material. And eventually it liquefies under enough heat and we get oil above a cap rock. Okay? That's what the rock layer below it that the oil can't seep down into is called. That's called a cap rock. So what do we use crude oil for? Basically everything. If you use fertilizer and you're a farmer, you're using crude oil energy. Your fuel, obviously, synthetic chemicals, motor oils, solvent, asphalt, plastic, illuminates. Look how much plastic's in this room. There, right here, there. So crude oil is a very, very, very important commodity. So basically, we're concerned with where we get it. And there's this perception in the United States that we get most of our oil from these politically unstable countries in the Middle East, Saudi Arabia, Iraq, Iran. It's not the case. About 55 to 57% of all the oil we consume in the United States comes from right here in the United States. It wasn't that way 10 years ago, it was only about 40%. More, a couple oil booms in the Bakken Shale in North Dakota, Permian Shale in Texas, North Slope, Alaska, are powering us to a more energy independent future. And like I said, the biggest states that produce oil, Texas, Alaska, North Dakota, and a couple we don't really think of as much, California, Colorado, then you have Louisiana and Mississippi right there on the Gulf Coast, they produce some oil. And then the stuff we have to import from other countries, after ourselves, we get most of our oil from Canada, Saudi Arabia, Mexico, Venezuela, Nigeria, and a few other countries. And I have a chart here that illustrates this. Where'd it go? There we go. Foreign imports by country. And the red part of this graph here is by Canada. By the way, this is from the EIA, Energy Information Administration. Mexico is in the dark blue here. Brazil produces a lot of oil at this point. They're trying to develop new oil resources in the Amazon. You have Kuwait over here, Venezuela over there. So really, only this part of the pie is Middle Eastern oil. About 30% of our imports, which are to begin with only 45%. So not that big of an exposure for U.S. markets. There are three main types of publicly traded crude oil in the Western Hemisphere. They are WTI, Brent, and WCS. WCS stands for Western Canada Selects. Basically, the Alberta tar sands oil is going to be WCS. This stuff is coming from Alberta, Manitoba, the western part of Canada, specifically the Peace River watershed. Brent is the standard that is used in Europe, much of North Africa, and parts of Asia. WTI is a standard we use in the United States, and WTI stands for West Texas Intermediate Light Sweet Crude. Now, they didn't call it light sweet crude for fun or because they wanted to describe how traders like their girlfriends. Light means it has a high API value, and we'll get to that later, and sweet means there's a low sulfur content. So most of the stuff in my oil is just carbon and hydrogen, and when I burn it, I'm going to get a lot of energy per unit oil I'm burning. If there's more sulfur, that's sulfur dioxide going into the atmosphere, and that's less raw mechanical energy I can get by burning it. So, a common question is, why are these three values different? Oil's oil, right? No. There's a reason WCS today costs about 52 bucks and WTI is up around $59, $60 a barrel, and Brent's at 67. Now the difference between WTI and Brent is mostly built on regulation, not the standard of oil. But WCS, that's that stuff from Alberta I was talking about, right? Alberta tar sands, that's what we're thinking here. And there's a reason they're called tar sands. When you get them out of the ground, they literally look like sand. They're just saturated with oil. So to get the oil out of the sand, we have to burn it. We have to heat it up and separate the solids from the liquids with a lower melting point. So to do that, we need energy, and we need energy from specifically American natural gas. So that's an input cost. I'm going to spend a certain amount of money to get that out. That's an extra cost I have to go through when I'm refining it, when I'm shipping it, when I'm getting it ready for market. So the raw product itself is not worth as much. It's kind of like a house. If you have a house that's already your dream house, you might pay 300 grand for it. Like, you know, Brent or WTI crude, they already have an API value of 35, and I send them right to the refinery. I just do a few processes, and I have a finished product that I can sell as gasoline. If I have my dream house sitting in front of me, I might pay, you know, say $200,000 for it. If I see a fixer-upper that it's going to cost me 80 grand to make my dream house, I ain't paying 200 grand for it. It's the same thing with oil. There are different standards of oil. There are different varieties of oil that require different amounts of energy to get to market as a usable product, and therefore there are different prices for those different standards of oil. Now over here, we get into another concept called speculation. You hear a lot about it on the news. If you watch Bill O'Reilly, you would think it's the root of all evil or something. But speculation is a very simple concept. Okay, so speculation. Now, this seems like a dirty word because we hear it on the news so much, and they try to vilify it, which, I mean, to some extent, yeah, it's bad, and we'll get to that there. But what is it at its core? Do we really know what speculation means? And speculation is we're buying into a product without an interest in the development, the supply, or the delivery of that product. AKA, if I want to buy a house, and the house is worth $100,000, but I think the house is going to be worth $150,000 in 10 years, so I am going to set myself apart from the rest of the pack and buy that house for $102,000. Problem being, my neighbor has the same idea, and he wants to buy a house. So he bids me up to $104,000. I bid him up to $106,000. He bids me up to $107,000. I bid him up to $108,000. Finally, I get the house for $114,000. So basically what has happened is I'm paying the price that I project will be paid in the future because I think I can make money on that investment. Do I really necessarily want to live there? No, it's a monetary decision. And I'm thinking in the future I'm going to reap profit based on it. And because I think that the value is going up, the value is going up because I'm going to pay more than it's worth right now based on just raw supply and demand fundamentals. So basically perception becomes reality a little bit. Same thing happens in the oil market. You have people who are going to produce the oil, who are actually going to bring it to market, like, you know, Chevron Corporation, ExxonMobil, you know, the owner of a gas station supply chain once it gets into the gas phase and out of the refineries and distilleries. And then you have the speculators, the people who buy up contracts thinking the value is going to go up, bid them up to a certain point, or bid them down to a certain point if they think it's going the other way, and then try to sell for a profit going either direction. Now in the 1970s, the market was 30% speculators, 70% producers. Today, it's 70% speculators, 30% producers. Now this has some ramifications, because if I'm a producer, I need the oil to carry out an actual process, distilling it, refining it, selling it. So if I buy an oil contract in March for say $50 a barrel, price goes up to 54, I'm probably not going to sell, because I need to make an actual product out of this thing. I want to let the contract, because that's what you're buying when you're on a commodities trading floor. The actual contract, I'm going to let it expire, I'm going to get the physical oil and do something with it. Therefore, there's less volatility in the market because there are less people always trying to buy and sell. I mean, unless there's some embargo on a country that produces a lot of oil, or unless the dollar just doubles in value or something, there's not going to be a lot of movement in this kind of a market where the producers dominate. If I'm a speculator and the price of my contract goes from say $43 a barrel up to 60, I'm selling. Why am I selling? Because I don't want the physical oil anyway. I don't want that barrel of oil. I want the money I think I can get out of it, and the gap between where I bought it and where I think I can sell it 3 months down the road based on constricted supply, increased demand, weather fluctuations, whatever the case may be. So therefore, when speculation dominates the market, the graph doesn't look like this anymore. It looks kind of like this. It jumps up and down all over the place. And this is what today's oil graph looks like. Now, speculation has kind of dominated the market since the 90s, took over a 50% share, but even back earlier in the 2000s, and we'll refer to this graph again later when we talk about hydrofracking and the 08 recession, even back in the early 2000s, when it was about 50-50, you can see this is a little more stable of a graph. Compare that to this period of time here that we're living in. Oil prices are not very stable, and that is based for the most part on the fact that our market is dominated by speculation. Okay, so the effect of speculation, more volatility. Also, price is going to go up faster when you get a supply constriction. We all know supply and demand, I'm assuming. If we don't, we've got bigger problems in this video. Or when demand goes up, when we get a good economic indicator out of, say, China or U.S. GDP numbers. Now, we need to look at one phenomena that's huge in the oil industry right now. Right here was July 2008, and the world economy was just humming right along, and the Middle East was not supplying any more oil. They could only keep production about where it was, but demand was going up really fast. We thought we were at a point called peak oil, where we couldn't produce oil as fast as we needed to consume it. Thus, the price shot up to $140 a barrel. Now, let's go back to Economics 101. When the price goes to $140 a barrel, what do you do to your usage of gasoline? That was rhetorical. I know you're watching a YouTube video. You can't answer. But what you should have said is, I cancel my summer vacation because it's $5 a gallon. AKA, demand goes back down. And what happened here? Oh yeah, a big recession. U.S. GDP growth was like -5% that quarter or something ridiculous. It was Q4 of 2008, albeit it was tied in with a big bank failure, but nonetheless, the high price took demand off the market, took money out of consumers' wallet, sent demand plummeting. All of a sudden there's no demand, and at the same time something else happened.